things over here. First, you try the new people because you wanted to give them chance, which is okay. We all do that when we start off. And the second thing you mentioned, honesty. Honesty and transparency are the two most important things in any deal for any sponsor, any operator. And communication is the key. And the thing is, the investors who are coming along the journey with you or investing alongside with you, they wanted you to be transparent. They wanted to know all the good, the bad, the ugly, because they wanted to see how you are digging deep and then getting your hands dirty in the deal. And they're staying away. They're watching from 10 feet away and enjoying the returns, right? But they need to know that if you're hiding all that bad and ugly stuff, they just feel like they're not on board 100% because they're not experiencing. They wanted to experience the deal through your efforts.
Disclaimer. This webinar is strictly for educational purposes and should not be considered as a legal, accounting, or investment advice. This webinar does not represent an offer to sell or a solicitation of an offer to purchase an investment or security. The strategies mentioned in the presentation may not be applicable for everyone. The information presented is believed to be accurate and reliable. We make no representation or warranties, expressed or implied, as to the accuracy of such information, and we explicitly disclaim any and all liability that may be based on such information and/or errors or omissions thereof. Please consult with your own attorney, financial advisor, and CPA for legal matters, investments and specific tax situations. Strictly a knowledge sharing for educational purposes only.
Good morning, everybody, and welcome to another session of Learn and Grow. And today we have a very special guest, my good friend Trevor with us. Trevor is an experienced investor with 20 syndications under his belt, includes 6 full cycles, and has served as a general partner for 5 syndications. With 45 years of experience as a vice president, he has opened and operated various transaction type businesses, including 46 of 80 iFly indoor skydiving locations worldwide. His passion for real estate investing has led him to become an active sponsor and VP investor engagement at Massive Capital. Through this role, he aims to help 1,000 people achieve financial independence through real estate investing. He is a dedicated learner and continually connects with like-minded individuals to grow his knowledge and skills. Welcome, Trevor. I'm super excited to have you with us.
I'm so excited to be here. I've been missing your meetings and I want to get here more often.
Glad to have you back. So we just wanted to hear about your journey. If you can tell us what inspired you to pursue passive investing to begin with, and now you slowly made your way into the GP as well, which is pretty awesome.
Yeah, so, my story is very similar to too many people's story. I was afraid of toilets, tenants, and trash, and I knew that I should be doing real estate investing. I was always interested in real estate investing, but to be honest, I was just afraid of it, and I didn't do it. And I kept thinking about doing it. And then, probably about 25 years ago, like many people, I read Rich Dad, Poor Dad. And I went, oh, a whole different way to look at it. But then I still went, no time, no money. Just offering that excuse, right? Just stuck with what everybody does, which is trade time for money, building your career, going ahead. I was super busy, working 70, 80 hours a week, traveling all over the place. In the back of my mind, I always knew that I was missing out. But somehow I just never got triggered or never got comfortable enough to go ahead and move towards it. Well, then what happened was iFly ended up getting bought out by a private equity company. And I no longer had the no money excuse. I just had the no time excuse. And I got killed on income tax, right? Which happens if you're just living for your ordinary income and you have some sort of cash event, you get killed. So, I had a few passive investments, but nothing big. Even at that time, work didn't even have a 401k program. So, I was really just living what I'm going to call paycheck to paycheck. And then I said, okay, that's it. I have got to do something about it. So I said, by the end of this year, I'm going to figure out this real estate thing and understand it. And I went to a couple of weekend webinar meetups, actually in-person ones, one of them told me, oh, they would train me how to buy an office building with no money down using a credit card only. And I went, well, that doesn't quite sound right, and went through. And then I finally was educated about apartment syndication. And it was like, poof, somebody opened my brain. And because I'd been doing this in the business world, right? We were buying up businesses, improving them. We were doing all of these things. We were growing what we called EBITDA, which is the same as NOI, really. And all of a sudden I went, why in the world did I not understand this? Which is part of my reason and my mission, to make sure that people don't wait to understand it. And then, I was hooked. So I actually said, okay, I'm going to make my first passive investment by the end of the year. I actually made two. And then I just started getting hooked, and I started getting connected in it. And I started learning, and, became fairly obsessive with understanding it, connecting with people, learning the model. And, since then, I'm actually now at 21 passive investments, 7 full cycle. And I'm on general partner side now on a few deals. And, it's just been like, wow, why did I wait so long? And so, my message always is very much the same. Don't wait to buy real estate and wait. And then until you figure out to make money in your sleep, you will work until you die. So until your money, and I don't know why I'm so thick. And I figure, okay, there's got to be lots of people out there that just, and so that's why I've gone on this crazy mission, just to keep talking about it, right? And no matter what, just start somewhere and figure out something and do it. A lot of us say, oh, don't start in the single family. My thing is start anywhere, right? If you're somebody in college, get your dad to buy an apartment and rent out the rooms, or start house hacking. Start and get somewhere to retrain your mind to have your money work for you.
Wow, I love that. So it's a start anywhere. I think any kind of investment is good in your portfolio, because you're growing your money that way, because money sitting in the bank is not doing much for you. So, but why multifamily in your case?
So,
Why do you think it was more?
So first of all, multifamily was what this group was promoting. Okay, so I just became educated on it. But it ticked a lot of boxes for me, because, I try to be a nice guy, and I want to see the world be made a better place, and I want to see these win-wins. And so I really understood, take an underperforming apartment complex that may not be run so well, may not be so nice and so safe, make it nicer and safer for the people that live there, treat them well. And I understood customer service business. That was my whole life. And so treat them like customers, and back that with a real hard asset, which was what was missing in my mind, right? That we actually physically owned a building, but what we were really buying was a business. And it was when those things came combined, I thought, okay, this is kind of like the trifecta. And I'm still very heavily invested in multifamily, although I've diversified a bit just because of the sheer number and amount of things that I've done, because I want to, try out some different asset classes and do some different things. But multifamily is still what I'm going to call my first love.
So you said multifamily is like a business, and your tenants are like your customers. So you're creating a good, nice community for the people with good living conditions. So when did that realization happen? Because most of us don't even understand, from the very get-go that, oh, it's a business that we're getting into.
There are so many sponsors that don't talk much about that. And I was very fascinated with asset management. So I started going to a lot of asset management training and learning from people that I consider that do it really well, and started hearing their stories. And it was life altering, right? One of my first passive investments on another deal in Denton, Texas, they talked about how they started an after school program where their apartment complex had a lot of Spanish speaking people. English was a second language to most of the people, and they were across from a school. And so they actually set up an after hours program in their clubhouse and taught kids English. And, they talked about bringing apples and juice and my mind was blown. They talked about providing the children back to school backpacks, turkeys at Christmas, all different. And I was like, that was what I needed to really tip me over the edge, right? These little things that we can do to make somebody, my theory always was that I wanted to invest and I wanted to be the sponsor of people that say, this is my home. Don't come over to my apartment, come over to my home. I live here, and the sense of community and, it completely changed my whole thinking. And yes, it's a business, and yes, we're increasing rents, and yes, we need the rent paid on time. But we have obligations too to take care of our tenants, to help our tenants. And so that's why I'm just so much in love with multifamily, just because of that. So don't get me wrong, as I said, I have a retail strip center. I have a medical investment. I know I'm in an investment with you with a new build storage. And we can talk a little bit more how I made those choices, and I did those because I wanted to diversify location and asset class, just so I can, everything is about spreading your risk out and looking at it. So most of what I started was what I call value add multifamilies. Okay, so those ones I call are like going for a home run. So I'm at bat and I'm going for a home run, right? So you're buying this depressed asset that's poorly managed, you're turning it around, and you're making it perform well, right? So you need a home run really to do well on a value add multifamily. But then I started learning and educating myself about how could I get a little more variety in my investments, right? So my medical investment, for example, I call it's a single. So anybody who doesn't know anything about medical investments, this is an emergency care that doctors, and so it's a triple net lease, but it's also double guaranteed. So what that means is the doctor's practice guarantees the lease and the doctor personally guarantees the lease, right? So that one, again, it's a lower return. It's a 10% pref only with no upside, but a fantastic place to put some of my retirement money and just what I'm going to call keep it safe. And so it's very important.
Yeah, I like that. I think you said it very well. And diversification is good. At the same time, looking at each investment as a business, because that you have a different mindset, and mindset is a very big thing in this. And the other thing I wanted to mention here is whatever is not in your perception, you do not understand that.
Yeah.
So you did a very, very good job that going to all these different meetups or networking sessions or joining these mastermind programs where you learn from other stories. That's the best way to learn. So I'm going to ask you if you can share with us, you went 6 full cycles, even though I said 4 in your bio before. So if you can tell us some good stories around those, how did that play out for you?
Yes, so I got
What was
the
the
good,
good
bad,
thing?
and the ugly, so unfortunately, again, this year I have my first actual loss of passive investment. It was a property and they had a fire and they didn't have enough insurance and they tried to sell and tried to do a bunch of things. And at the end of the day, they were about to be repossessed. So instead of being repossessed, they actually had to come up with some cash to get the project to zero. So that wouldn't go on their record, and we lost our investment. Very unfortunate. Doesn't happen very often, out of 25 deals now, but it is a reality that there is that possibility. And then on the other side of the spectrum, one of my first out-of-state investments, they tripled my money in 20 months. Boy, that was nice to have that. I call that's not only a home run, that's the grand slam, right? Bases were loaded. And it was a great investment. And of course, I invested right away as soon as I get that money back with that same sponsor, because you just get that confidence level up, right? And it was also, you got to remember, it was during what I'm going to call the heyday, right? It was one in Tucson, Arizona. All those people fleeing your crazy state of California were moving to Arizona and Texas. And so I managed to ride that one up on the wave.
So you gave us 2 scenarios. One deal went downhill and one you did 3x in 20 months. So what was the factor that made it so successful for the successful deal? And what went wrong in the other deal?
So what went wrong in the other deal was inexperienced asset managers. They were, I guess, I kind of believed nothing could ever go wrong in Austin, Texas. We're just going so fast. And what had happened, something went wrong. And they did not have enough insurance. They ended up having a fire. They ended up where the fire was disrupted the whole property, and it ended up not just like one building burned down, but they ended up having to close the whole property. Then they had it up for sale, and it dragged on for 5 months, and then the sale didn't go through. So just what I'm going to call a series of very unfortunate events that happened. And on the other side, I'm going to call it a series of great events, right? So first of all, a really strong operator. This was their fourth or fifth purchase in that marketplace, so they understood it. They had a team already in place. They knew property managers in place. They knew how to buy it right. And then, of course, we managed to sell it at a time when before interest rates started to go crazy, right? What was happening with the Austin deal? They were trying to sell it, but it wasn't working at 7-8% for an unperforming, because especially if you have an unperforming asset, your interest rates and your loan to value were so low, they just couldn't get out of it.
Interesting. So you had the experience, good and bad, very early on. So can you share with us what are the good things in a strong
Well, the
operator
bad
versus
just
a weak?
happened this year, so 5 years in. So I've
5
been
years
on a
in.
good roll.
Okay.
I've been on a good roll till then, and everything else, I'm going to call it performed as expected. So everything else, was in the 15 to 20% IRR rate, right? The one deal I have that's underperforming right now was a retail strip center, and we closed March 15th, 2020, so sort of bad timing. They had a lot of struggles, and it was also a value add. But what's happened now is they've got all the tenants on triple net lease. They've got one more space to fill. They have been doing a 5% cash on cash, so it's been cash flowing. But as soon as they get this last space filled, then it will sell, and we'll get a good exit return on that one. That was never meant to be a cash flowing, type of property. It was very similar to a value add, only in the retail space.
Great. So going through this experience, the good, the bad, and the ugly, I would say, because you had very good deal, very bad deal, and kind of average deal. So so there is our operators now, the strong operators and weak operators. So if you can tell us some traits and how to spot those, in a good operator versus a weak operator.
Yeah, so first of all, you really got to get to know people, okay? You've really got to get to understand people. For a long time, I said that, but I maybe invested in a couple of new people just because I was a new people. So I thought, well, I want people to give me a chance. And another thing is people that are very willing to share information. So this particular one that I did very well on, they actually presented a deal that they really struggled on. And they actually were honest about it. They invited people and said, this is what happened. We ended up saving the deal. And and they basically said the market saved us. We didn't save ourselves. And here's what we learned. And that honesty blew my mind, right? If anybody looks too good all the time, chances are something's wrong. And, so I like that honesty. And just to get to know people and what's important to them. I'll tell a story for me and you, Vinky. We got to know each other. I consider us great friends, even though we've already been, we never met in person or anything, but a lot of time together, a lot of things together. And I wanted to do a deal with you, right? And in fact, we invited you to one of my first GP deals. It didn't work, so I'm glad you didn't join that one. But and then what happened is I passed on a couple of deals you sent me because I wasn't looking for that particular thing. And next thing you know, I wanted to get something in the Carolinas, and I wanted to do something in storage, and I wanted to do something with Vinky. And I call it the stars aligning. And so that makes a decision, right? So a lot of people think, oh, I got to hurry up and do a deal. It's not always the case. Sometimes just taking your time a little bit and waiting for what you want, what you need. And again, it was a different performing deal, right? It's not cash flowing, it's a new build.
Mhm.
There was no big bonus depreciation because it was what it was. And so it was a great place for my retirement money. I remember I called you and the first question I said, because I knew you'd tell me the truth. Vinky, is this a good spot to put my retirement money? And and you said yes. And I think that afternoon I filled out the paperwork and filled it all wrong first. I always fill out the paperwork wrong the first time. It's something about me. But but looking for those things to come together help you feel a lot more comfortable of what you're doing. And then once you are doing business with people, or if you're not yet, talk to other people. How are they communicating? Are they giving you updates? Are they explaining what's happening? It's you really want to, and I ask sponsors, by the way, I'm not going to invest in that deal, but would you mind sending me your investor updates? And if they say no, I'm not interested. But again, this one that I did my big home run, they sent me their investor updates. They put me on their list, even though I wasn't an investor. And now I'm a fan, right? And I've invested twice, and I think I've sent several people to invest.
Thank you for sharing that. I think you said a couple good things over here. First, you try the new people because you wanted to give them chance, which is okay. We all do that when we start off. And the second thing you mentioned is honesty. Honesty and transparency are the two most important things in any deal for any sponsor, any operator. And communication is the key. And the thing is, the investors who are coming along the journey with you or investing alongside with you, they wanting you to be transparent. They wanted to know all the good, the bad, the ugly, because they wanted to see how you are digging deep and then getting your hands dirty in the deal. And they're staying away. They're watching from 10 feet away and enjoying the returns, right? But they need to know that if you're hiding all that bad and ugly stuff, they just feel like they're not on board 100% because they're not experiencing. They wanted to experience the deal through your efforts.
Yeah.
And that's very important. That's what we have to understand, being in this position. So,
and also, do they take your calls and answer your questions? Like, or if you said, again, I was on a deal, it was terrible. Nobody was communicating with me. I actually sent them a note saying, have you lost my money, or am I making any money? And they never replied. And they said, you're making money. And I said, well, could I please have some proof I'm making money? And their email back was nothing. I sent them again and they said, would you like to be bought out? And I emailed back, absolutely, make me an offer. Never replied. And then a few months later, they actually did buy me out. They bought all of us out. And it was a deal that was the opposite of what happened at COVID. A lot of things went well for other properties or things. This particular one, their buy box in Texas, this was a single family fund, and their buy box blew up and they couldn't buy anything. And because it made no sense, it was basically they were buying everything on what they call the 1% rule. Well, the 1% rule disappeared when Texas real estate doubled in 2 years.
So since we're talking about the due diligence for the sponsor, the operators, I'm going to ask you this question over here. What are some of the misconceptions that passive investors have regarding the passive investing? There is so much hesitation to get started. So what advice would you give? I know you kind of researched and then you thought this is my right time. I'm going to go ahead and jump in. I'm going to try that out. But a lot of people, they're just sitting on the sidelines waiting for an opportunity. But unless they take an action or make a move, that might not happen for years,
Yeah. So again, at some point, you just have to do it, right? At some point, I've been doing this for 5 years. I consider myself pretty smart, and I'm still not really smart enough, right, to be trusted on my own, in theory, because there's so many factors to consider. There's so many things in the world. So at some point, you just have to do it, right? And again, you've got to remember, 25 investments. Okay, I've had one that hasn't worked. And on the whole, even my good, bad, and uglies and the people, even the one that they never communicated with me, I got a 5% cash on cash with my money. And again, that looks better when it's not 7% inflation rate. But again, it worked out all okay, right? Because real estate does appreciate, and a lot of people, you got to make sure you understand real estate is not a get rich quick game. Real estate is time and money, right? Time and money, letting your money work for you over time. and then, just making sure. So again, I think the most important thing is to ask around if you don't know. If you're new and you're starting, I went to everybody's webinars, and then I would find people on the webinars, that seem to know the sponsor, and reach out to them and say, would you mind telling me, something about this person? And myself, I recommend very few people, because I'm very cautious, right? Because that's a big thing to do. But there are people I recommend, and say, hey, listen, my experience to date has been good. Obviously, do your own due diligence, but and at some point, you just have to trust your gut, right? And make a decision.
That's true. That is good. But the thing at the same time, you have to pay attention to some signs and the information
Yes.
that's been delivered to you. That's more important sometimes than the gut, because sometimes you like somebody when you meet them first time, but not necessarily you wanted to invest with them 100% until you know the inside story. Inside stories is like the communication, how they're communicating with the investors. Because to me, each and every investor, whosoever comes into your arena, they're looking for some experience. They're looking for something beyond their capabilities, what they can do. I mean, if you look at it, it's a very simple thing. You buy apartment building, you update that, you sell it, you get the profit, you are done by the end of the day. But it's not a cup of tea for everybody,
Yeah.
Some people, go ahead.
And think about this too. Think about your money in your stock market or your 401k in a mutual fund. Well, who do you know? What control do you have? Russia invades Ukraine and your retirement fund drops 20%. How in the world, how do you feel comfortable with that? You just, because it's our normal, we start to accept it, that, okay, well, that's just the way it is, right? Bill Gates still hasn't taken my phone call. Elon Musk built a factory here, and he still hasn't done it. And so can I pick up the phone and ask Elon Musk, what in the world are you doing? Are you risking Tesla because you bought Twitter? I mean, of course not. But you can do that in this business, right? You can reach out to people and ask questions like that.
And that's a really, really good example of diversification, right? Elon Musk buying Twitter and just taking it totally downhill. So let's talk about your diversification. Earlier you were talking, you can share with us what made you look into the other asset classes beside multifamily.
Yeah, so first of all, I want asset classes. And to be honest, when I first very interested in if somebody came in and put a business in there and their family runs it. But since COVID, I'm a little spooked on retail and office, though that was something that always interested me. And then, even I still do have a retail investment I mentioned. And then, to be honest, medical centers always been in the back of my mind. And it became on the front of my mind during COVID, right? When a lot of people were leaving major medical centers. And, I just see, I'm living in Austin here, and it feels like every few months, one of these centers open up that are smaller spaces outside of a core. I always see people there, and it just sort of triggered that, okay, this is a space I need to get in. The next space I'll probably start looking at is retirement homes. They're very risky, right? Because it's a subset of a high maintenance set of population. But eventually I'm going to be there. And at least I'd like to own a piece of where I'm paying rent or something. I don't know, but it's, again, it's, to me, it's kind of like, it's not anymore, but for a while it was the blue ocean, right? It was where there wasn't a lot of people doing it. There were some big institutions, and some people have gotten into it. And I definitely think there's two ways to look at that space, right? There's the bigger, higher end, nice ones. And then there's these ones now that some friends of mine are doing, where they're homes, and, that one is, again, very operator dependent, but it's a space, we're all getting older, right, in America. So it's a space that's going to have some room to grow. And, I actually spent a lot of energy looking at it during COVID, trying to buy old hotels and turn them into nursing homes.
Mhm.
And it was terrifying. If you don't know what you're doing, it was a real good way to flush everybody's money down the toilet. And so I backed off real quick.
That's
But
true.
I probably spent 4 or 5 months really looking at it. I was gonna buy like that old extended stay at, because it didn't need to be a great geographic area. But boy, it's a tough business if you don't know what you're doing.
That's true. And I think there is different classes too in that,
Yeah.
in the retirement homes too. I'm invested in one in assisted living. So it's depends, where you want to get in. I know a lot of people are converting the hotels into assisted living. It
Yeah.
works for them because they have the background to do that. So I'm going to ask you one question here is, now you're a GP with all your LP investments, 20 plus syndications that you have. How do you balance your active and your passive investments portfolio at the same time?
Yeah. So my goal is to always be passive outside of my own. I'm never going to have all of my eggs in my own basket. I just don't think that makes sense, right? I've got to believe that there's people and asset classes that will do a better job even than me, even though I think I do a good job. And, and then some markets I want to be in. And I'm still learning from those passive investments. I spend a lot of time learning and asking questions. And if you're not an annoying limited partner, I call it the Monday morning quarterback calling up, why did you make this play? Why did you do that? I could play the football game better than you. If you actually call up and say, I've got some questions and I really just want to understand, why did you do this? And why did you do that? And you've got a good sponsor that will answer those questions, you can learn a ton. You can continue to learn even as a passive investor that should help you. And for me, it showed me how I wanted to be treated. And my goal is that my deals treat people the way I wanted to be treated, and communicate and protect their money and put them first.
Great. So can you also talk about some of the tax implications of passive investing and how you can minimize some of the tax burden, or how did you do it in your experience? And now
Yeah,
being
so
on the active side too. Mhm.
yeah, when you're a passive investor, in reality, the only tax savings you're getting is it comes to you as capital gains versus ordinary income. And then your depreciation can write off your passive losses. Okay, so if you take those two things, in theory, it's pretty close to tax-free income. All right, it's not saving your W-2 income all the time, but it is tax-free income. And I've got some friends that have been dabbling in the Airbnb space, and they actually can write certain things off their W-2 income. And I know there's some other investments that allow that. But at the end of the world, where in the world can I stick my money and in theory earn on it tax-free? There's nowhere, right? So that's the power of just a person who's a passive investor that still has a job. Now, when you switch to the professional real estate person, it's like somebody opened up the candy store and it's all free, right? There's huge benefits, and you can take all of those passive losses. And Mr. Trump famously said, I pay no income tax, and they pays no income tax because the system is built to help people that do that. And so it's something that you really need to take advantage of, right? Because your stock market earnings or any of those other earnings, they're still taxable. They may be capital gains, but they're still taxable. There's still no other write-offs.
So I recall earlier when we started the conversation, you mentioned that value add was more like a home run. So not so more, right? So what do you see the future for the passive investing?
I still think value add is a home run. You just got to be careful buying it right, getting right debt, making sure that it works. Where it's not become a home run now is people were overpaying, over leveraging, and interest rates went wacky, right? So it's kind of like 3 strikes, I'm out, So if you buy right, you finance right, then it's still something that value adds, right? So again, on a couple of our deals, we have new debt and it's working at those interest rates. And then when interest rates come down, it's only going to work better. So if it works today at those rates and still can produce a 15 or plus IRR, hopefully in 3 years when you can refi or do something that's better than. So the people that are in trouble are the over leveraged and the people that were on bridge debt with floating rates. There's still, again, you're gonna pay 5, 6, 7% on fixed debt. Your loan to value has gone down. I mean, we all know about that big thing that blew up in Houston, right? That big deal in Houston. And I've heard stories, they were 92% leveraged. Just think of that on a, floating interest thing. And, wow, that's tough.
It is.
That's a bad situation.
So what are your focus markets now in the given market condition that we are in? And also, what kind of due diligence that you're doing, or what changed compared to pre-COVID, or how you were doing deals? Apparently, you might have more strict criteria to see who you wanted to work with.
So definitely it's I'm definitely more particular right now. Because we still don't know who's swimming naked. The tide hasn't gone completely out, right? So Warren Buffett says you don't know who's swimming naked till the tide goes out. And obviously, there were some people naked in Houston, and there's a few others. So we're still not 100% sure. But what you really need to do is you really need to make sure that underwriting is realistic, right? It's just, and does the deal work? I mean, we're buying a new deal right now. I can't talk about it because it's a B, but and it's 6.1% interest rate and it works. And it's fixed debt, it's not flexible debt. And so we know what we're doing going into it, and we know where the rents are and where the rents can be, and the numbers work. And we think if we hold it for longer than 3 years, there'll be an opportunity to get better debt.
Awesome. I like that. You mentioned underwriting numbers, so what do you look for in underwriting in today's market in the assumptions perspective? Because I recall, during the COVID days too, when people have outrageous assumptions, they think, by putting the numbers in, they can manipulate whatever way they want it, and they can show the rosy picture to everybody. But, what would you advise to my audience, our audience, what they should look for?
Yeah, so it's really hard to because you can make spreadsheets look like anything, right? That's the more I learned about underwriting and qualification. I'm not the world's greatest underwriter. I can't do it. I can read it. I can understand it. So again, realistic assumptions. Like if you look at some of the deals that were happening at the middle to end of last year, okay, they were showing 10% rent bumps and 2% expense bumps. Do you think those deals are performing with 10% rent bumps and 2% expense bumps right now? So I passed on all of those deals. So I always look for realistic rent bumps, and I look for realistic expense bumps, right? So clearly, if you're in Texas, boy, you better be looking at your insurance. We underwrote a deal and we put the insurance up 20% this year and 20% next year, knowing that's going to happen.
Great. So looking into your crystal ball, what do you see for the next couple of years, given the market situation that we are in? Because a lot of people, they're thinking we're already in recession, inflation is all-time high, job market is okay, and then and population growth is happening in a lot of areas, because people are moving to different places. So what do you see in your crystal ball, and how you're aligning yourself to all these conditions so that you are successful by the end of the day?
Yeah, so again, a little bit more shifting, and we didn't even talk about this. So I've been doing some land as well, and I'm involved in a new build thing, a new build opportunity. And some of those are opportunistic, right? Because they still work, and it's it's different type of debt already. And so I've been actually doing fairly decent on the land entitlement side, just because land is still going up in value, right? Land, and there's not a lot of expense metrics in there that happen. But at the end of the day, you just have to look at common sense, right? You know, like things are going to get better, right? 2, 3, 4% interest rates was not normal. 5, 6, 7, 8 interest rates is not normal. I believe we're going to go back to normal in the 4, 5, 6 range, right? Depending on where you are. Debt leverage and 20% and 100% of your, loan to cost of 85% deals. I never invested in one of those ever, and I never will today, tomorrow, next year. You just can't, right? They're too much of a teetering on one thing going wrong and the thing tumbles down. I think there's going to be more buying opportunities because there's still great properties that have poor debt structure or poor operators. And, they're going to be able to be bought at the right price.
Awesome. I love it. All the information. Thanks for sharing your insight. I'm going to open it up for everybody. Anybody has any question for Trevor, please raise your hand. I'll bring you to the spotlight.
Yes, Trevor.
Yes.
You talked about the investment that you had. This was the negative one that did not work out. And I think you said that that was a fire.
That's correct. And they did not have enough replacement insurance.
Okay. Now, was that before the pandemic or after?
It just happened. The fire happened in the summer of last year, and they struggled, limped along, tried to sell it, and then they fell through. And then it basically, it was January of this year. They sold it at a loss.
Okay. And I think just to follow up on that same property, I assume it was a value add and they had a bridge loan.
That's correct.
Okay. Now you jumped to today. I think you said that you're working on a property now. I think you said 4, 5, 6% interest rate, something like that. Is that a value add, a bridge loan involved with that?
No, it's a fixed debt loan. So it was an assumption of a fixed debt loan.
Okay. So you're assuming this one.
That's correct. It was a loan assumption. It was just over 5%. So good on today's terms, bad when it was, but it is a fixed debt. It's not a flexible debt.
Okay, I got you.
Yeah,
and
fixed debt is very important, because you got to know, right? And again, who'd ever thought this would happen?
Yeah, that's true.
Anybody ever think this? I think I'm a moderately smart guy. I never saw, that somebody got a loan at 4.2% and now it's going to be 6.2%.
Yeah, that's true. And I just want to still follow up on that because a lot of us got into the market because of the value adds, as you said earlier, and it is attractive. And of course, you could double your money in, shall we say, a very short time, most times less than 5 years.
Yeah.
And so it was quite attractive. And a lot of us got into the market. So we sort of hooked at that value add level. Now we've gotten to today's market and we're trying to figure out, of course, the newer properties are a lot more attractive, but we can't forget about the value adds in those days and the monies that we made on them. So I'm just trying to get you to throw something at me. Do you think that day will return again?
Oh, I definitely think it will, but it will be 2 to 3 years. Because I think, again, value add deals work when you don't do something really crazy. Okay, so value add deals work if you're not like at a 92% leverage we talked about, right? You're at a decent leverage and you've got a decent cap rate or you've got a fixed rate, then they work. Where they don't work, just because of what happened, right? That, again, I'm on 2 other deals and their cap rate's expiring, and they did a capital call to buy a new cap rate, because they just didn't have enough money to buy it.
Yeah.
I still believe those are value add deals. We're just not going to get our money in 3 to 5 years. It's probably going to be 5 to 6. Okay. And I still think we'll do well because I still think the world will go back to closer to normal and they'll be able to sell. Because again, if you're in a high growth market, so everywhere I've invested, I'm not in a sub market, right? I'm in Austin, I'm in Dallas, I'm in, the Carolina, I'm in high growth markets with no indication that something's going to slow down in those markets, right?
Okay. I agree with you there. And you also said about the interest rates, and of course, being very, very sharp on your underwriting. And I'm sorry, not interest rate, the insurance rates.
Yeah.
Is that a steady increase every year? Because we keep talking about insurance, and that's a constant conversation. And do you continue to see it going up the way it's been going?
So I hope not. Texas is crazy. I got a friend who went from $300 a door to $900 a door.
Yes.
And it's really hurting them, and it's very challenging, to pass it along. I hope it doesn't keep going up, but it's tough in right now in Texas is tough. A lot of people don't realize this. You remember we had a snowstorm 2 years ago called
Yeah.
the Snowgeddon? That
Yeah.
was a larger insurance claim than Katrina. Think about that. Katrina was a pretty big insurance claim, right? A lot of devastation. So eventually things will normalize. I believe insurance companies are somewhat regulated that, they have to at least show their loss runs to justify their increases. So I don't think it's going to go way down, but I'm hoping there's normalization.
Okay. Very good. Thank you.
Thanks, Ken. So you mentioned capital call, Trevor, earlier.
Yes.
So what happened? Why there was a capital call, and how it was communicated to the investors?
Yeah, so it was all done poorly, unfortunately. They sort of slowed down on their communications, and then they did a webinar that the link didn't work, and then they sent a recording out. And then I actually did a one-on-one call with the whole GP team just because I'm pushy, and and I actually was pretty hard on them. And I put my money in because I want to stay with the deal, right? But I'll be honest, I had two capital calls. One, I don't think they made it big enough, which is crazy, right? I should give you more money because I think you're going to ask again. And every time they ask, there's less likelihood of people ponying up to the capital call. But both of those were to buy a new cap rate to protect the increase of interest rates. So both of those were, we don't have enough money. And if we don't buy a cap rate again, we're going to be, cash flow negative.
So the investor participated in the capital call?
They did. They have not reported yet, which I've asked how many of us did. And again, the one, I thought they didn't do a big enough cash call. I thought they should have done larger because I think they had some more issues than just the cap rate.
I think this is a good thing to talk about and think about when people are investing. Try to find the sponsors or the operators with the deeper pockets at this time in this market, especially, and not to invest with anybody who cannot support their own deals, because the investors, they don't like to put more money in the sinking ship. So I have Kalina. She has a question. So
hi there.
Please go ahead.
Hi, Trevor.
Hello.
I understand you have diversified your investments not only in the different real estate class properties, but also in different states. Yes. And I wanted to ask you, what is your experience investing in North Carolina, and in what assets you have invested? And yes, the second part of my question is, what is your opinion comparing the North Carolina multifamily or commercial real estate market with, for example, Texas or Florida?
Yeah, so I like the North Carolina market. And again, the one I'm on in North Carolina is a storage unit, a new build. Vinky's one of the sponsors. I also spent some time getting to know her partners. I'd met them a couple of times, but spent some time getting to know them. So I really like the Charlotte market. And actually, my brother lives in Charlotte, and I've got a bunch of friends in Charlotte. And so when I sent them all the address, and again, this is doing some of your due diligence, because I didn't know this community within Charlotte area. Everybody said, wow, that's a hot market. That was the answer. Wow, that's a hot market. Everybody's moving there. Everybody's moving there. So I did that. And I think Charlotte is a really strong, good, steady economy. It's a little different than Texas. Texas, is like so huge, right? That we've got room to grow. Where Charlotte, you know, it's you're on top of people a little bit more, and it just doesn't. There may be there. I've just not seen them. There's not as many value add deals there. Because a lot of it has been newer built. We're in Texas, man. We got a lot of 1960s properties for sale, like a lot of them, and you know, so
Great.
Great. Thank you.
yeah.
Any follow-up questions, Kalina?
I do have one more question for Trevor. Once you finish, I'm sorry, go ahead.
That's okay. I understand that your only investment in North Carolina is in the Charlotte area in
That's correct.
storage unit, not multifamily, correct?
That's correct. That is correct. Yes. And I have one active investment in Columbia, South Carolina. And that's my only 2 investments in the Carolinas, although I like the market.
I know, I love it too.
And excellent. And why do you love the Carolinas market so much in comparison to, let's say, Texas or Florida?
Well, I like the similarities of Texas. So you gotta remember, like 70% of my investments are in Texas, 80% I'll probably. So I'm very heavily Texas investment. So I wanted some spread, and I'm looking for pro-business, big growth markets. And Carolinas are pro-business, and they are great growth markets.
Yes.
You know, with a mixture of good, sustainable working class people and high net worth people. It's just got that nice mix that I like.
That's true. I can agree.
Excellent. Thank you.
And there is
Yeah.
250 people moving to Charlotte every day.
Yeah,
To
it's
add
a
to
high
that.
growth market.
It's a
you
high
know?
growth market, really, really good. I think both South and North Carolina, both are good markets,
Yeah.
depending upon even what sub-market you're targeting. And then I actually have a deal at current as well that I'm raising for. It's a 506C, and anybody wants to look at it, it's still open. Any more questions, Kalina?
I do have one more if she is finished.
I think she is.
I think
Oh.
she is.
I am finished. Thank you. Appreciate it.
Thanks,
Thanks.
Kalina. I'm gonna move you back, and let me bring Ken back in. So Ken, go ahead.
Yes, Trevor. We talked about the current deal you're working on, and it's a loan assumption. I think my question is, in your loan assumption, are you looking for at least 3 years fixed or higher, or in that general area?
Yeah, so both of the deals I'm in, one has 6 fixed and one has 7 years fixed. So
Very
still
good.
a long time.
Very good.
Yeah, and the one, unfortunately, all the interest only's out. So again, you know, that makes cash flow tougher. But the other deal still has some interest only left on it.
Okay. Thank you.
And again, it's knowing where you are, what your payment is, and it's you know where you are. And right now that's super important because a lot of people didn't think they'd be where they are today.
Okay. Thank you.
But it's tougher to do because you got to raise more, and investor money is still the most expensive money. And so it makes it hard to get some of these deals to work.
Okay.
That's true. I agree, and especially these days in this market, you don't even know how much to raise sometimes because it depends upon the loan, you know,
Yeah.
what percentage you're getting. So that's kind of squeezing, and the raise is getting kind of higher. So it's like a little bit tricky situation in today's state. And then pref works sometimes in this kind of market. So any more questions for Trevor? If not, Trevor, can you please share your contact information?
Yeah,
How
I put
to
it
reach
in the
out to you?
chat. Yep, I can stick it there again just to be safe. And I got this new fancy thing called a link tree. It's like I know what I'm doing here, and it's got everything in there, including a link to book an appointment.
That's awesome. I love that. And once again, I'm going to say thank you, everybody, for joining. We'll see you next week at the same channel. I have another call at the top of the hour, but it was super awesome and very insightful session. Thanks again, Trevor.
Oh, it's my pleasure.
And I have a
Thank
good
you, Trevor.
Bye,
So
guys.
nice to see everybody. Thank you so much for coming out.
Bye-bye.
Bye.